Hello, everybody. This is Eddie Gabor, CEO and co-founder of Key Advisors Wealth Management. And I wanted to shoot this video today to spend a little bit of time talking about bonds and why we are so bullish on bonds. It's been getting a lot of attention lately from our national TV interviews. And it's one of those things where I think it's a very misunderstood asset class. Because let's face it, most of the time, if you're watching TV and the financial networks, they're spending most of their time talking about which stock to buy, which sector to buy in the equity markets, and very little time spent on fixed income. And look, fixed income is boring for many people. I've never been really excited about being bullish on bonds, but at the same time, we're here to try to make money in the best risk-adjusted manner for our clients. And if the signal is telling us and everything we're looking at is telling us that it's game on for bonds, and we want to make sure we take advantage of that, okay? So when I talk about the bonds that we're buying, okay, we are buying ETFs for our clients, and we are overweight the longer term bonds, okay? Now look, if you just take a look at what a 30-year government bond is paying, or a 10-year government bond, or 7-year, you're going to look at that yield and it's probably not going to get you very excited, okay? And it wouldn't get me that excited either. So our play on bonds is actually a play on appreciation in the actual bond price, okay? No different than buying a stock that you think is just taking a beating, and you're buying that stock because you think it's going to go up. That's the play we are taking right now on long-term government bonds. If you take a look, last year was one of the worst years in history for long-term government bonds. And that's why so many investors, even in a diversified strategy, took such a big hit. Because even if they had treasury exposure, the asset prices of those came down quite a bit. And the reason why is interest rates were soaring last year, okay? And bond prices work inversely with interest rates. So if interest rates go up, bond prices go down. So if you're in an environment where you're seeing acceleration in rate hikes and you're seeing the long end of the curve or short end of the curve go up, that underlying asset class is going to really struggle. Well, now we think we have the complete opposite scenario in 2023 than what we had in 2022 for the setup. We believe we have seen the highs in interest rates. Again, we're talking about the long end of the curve. And the long end of the curve has nothing to do with the Fed, okay? When the Fed raises rates, they're affecting the short end of the curve, not the long end of the curve, okay? Now, our call on this is because we believe we are in a recession right now. And the saying in our industry is the bond market is a forward indicator of future growth, okay? So if long-term rates start collapsing and going down as they have been the last few months, to us, that is one of the many signs that we are heading into an economic slowdown. Well, it has been of our opinion that we are going to have a recession this year in 2023. So if we're going to have a recession, and that means, in our opinion, the long end of the curve is going to start really coming down, then we want to be big buyers of any dips in that asset price. So when we have had days where interest rates have really spiked, we have tried to incrementally add to long-term bonds. We're using ETFs, not individual bonds, because this is a trade. This is not a long-term hold for our client base. Our opinion is there's a lot of upside potential there just because of how big of a beating they've taken. I mean, some of these long-term treasury ETFs that we're buying are still off 20 to 30% off their highs, okay? So again, when you take a step back and think about that, you have an asset class that is considered by many a safer asset class that has lost 20 to 30% of its value. And now we believe that there's some upside for our clients because of the fact that we think rates have peaked and we think interest rates are going to be going down. The other thing too, because we're risk managers at heart, right? Everything that we do, we're looking at it from a risk management standpoint to try to protect and grow our client assets. Let's say that we're wrong in regards to the market, because we're very bearish on the market here over the near term. And let's say that the bulls are correct. And the bull thesis for many of them is that the Fed is almost done raising rates, and that's going to save the day, okay? Well, if the bulls are right, which I agree on the fact that the Fed is almost done raising rates, I don't agree it's going to save the day in the equity markets, but let's just, for the sake of argument, say that we did agree with them. So if the bulls are right, and the Fed's going to stop raising rates and maybe even potentially cutting rates, well, guess what? The long end of the curve, in our opinion, is still going to go down in that scenario. So in a bullish case, will still get upside in the bonds, not nearly as much as in the bearish case for the economy. But in either one of those scenarios, we believe that that asset price will still do well for clients. So to us, it's a no-brainer to be overweight that asset class. So cash is still our number one holding. And then number two, right behind that, is treasuries in a big way. And we're extremely underweight equities. We think equities will be a buy later in the summer. Okay. Now, the last question that we're getting is in regards to the debt ceiling debate. As we get closer to that, the concern is how does that impact treasuries, okay? And no one really knows how it will impact it. It will depend upon how late it gets. So to hedge our bet, as we get closer to that debt ceiling kind of death cross on when they need to come up with an agreement, if we've had a really nice move in bonds, we may trim some and just sit on cash and wait and see what happens, okay? But in 2011, the last time we had this issue, it affected the short end of the curve more than the long end of the curve, okay? So I can't stress it enough. Our play is on the long end of the curve. That's where we think the most upside is from a price perspective. And if we're right, we're going to get some handsome returns for our clients and put us in a position to be able to take profits and buy equities in a big way as we get to the summer and fall. We just think it's prudent for our client base to just kind of sit back and see what unfolds with this second quarter, as well as the debt ceiling debate that, again, is on a crash collision to meet at the same time. So that's our quick take on bonds, the rationale behind it, and understanding why we are making this call. So I hope this helps educate you on what we're doing and why we're doing it. And more importantly, I hope it helps you put yourself in a better position to make an informed decision for what you think is best for you and your family. Thank you, and make it a winning day.